Hello, and thank you for joining us for today's market briefing. As we begin the new year, we often pay special attention to market movements in the month of January. These movements can provide valuable information as to how the rest of the year might progress. So what trends have we seen so far in the markets? In general, interest rates are rising and the stock market continues to rally. In the bond market, we have seen short-term interest rates hold relatively steady, while longer-term interest rates, such as the 10-year U.S. Treasury bond yield, have increased sharply. In the stock market, the composition of the rally continues to evolve, with some parts of the market that had lagged in last year's recovery now taking the lead. In particular, we have seen a strong rally in small cap stocks, which have risen more than 9%. We have also seen a strong rally in more value-oriented sectors, such as the strong increase in energy stocks, as well as continued gains in financial stocks. But what is behind these trends in the market? We can point to a few key events so far this year. First, the rollout of COVID-19 vaccines continues to gain momentum. The pace of vaccination started off slow, with less than 7 million people in the U.S. having received a vaccine as of January 8th. That's equivalent to about 2% of the total population. The pace of distribution continues to improve. Forecasts estimate that within the next few weeks, more than 1 million people per day should be receiving the vaccination. Markets are understandably excited to see light at the end of the COVID-19 tunnel. As the idea of mass vaccinations or herd immunity becomes reality, investors' focus will shift to what the world we return to will look like. The results of the Georgia Senate runoffs held on January 5th have also impacted current market trends. With Democrats winning both seats, the balance of power in Congress now shifts narrowly to Democrats. In the short run, Congress has focused on the next round of fiscal stimulus, but investors will be watching for new developments in fiscal policy as the balance of taxing and spending starts to change compared with the prior administration. One last event that we'll highlight is the swift confirmation of Janet Yellen as U.S. Treasury Secretary in the new Biden administration. We expect that the Treasury and the Federal Reserve will work very closely on fiscal and monetary policy going forward, especially since Janet Yellen previously served as the head of the Federal Reserve. Strong fiscal and monetary policy support will help bridge the economy through to recovery. A good example of this is corporate earnings, where the pandemic negatively impacted profits, but monetary and fiscal stimulus more than offset the negative impact of stock prices. If monetary policy were not so supportive, prices might decline as life returns to normal, so that they align better with the recovery in earnings. To conclude, while COVID-19 remains a critical health issue, positive vaccine developments and abundant market liquidity have provided a boost to the prices of risky assets. Government spending was going to be substantial regardless of the composition of government, but the blue sweep by Democrats increases the odds of further fiscal and monetary accommodation going forward. This year is shaping up to be one in which Wall Street gets continued support from the Federal Reserve in the form of zero interest rate policy and quantitative easing, while Main Street is supported with continued checks from the government. With a legitimate path emerging to the end of the COVID-19 crisis, a key to navigating this year will be redefining normal. From all of us here at RMB, thanks for tuning in. We hope you're able to join us for our next market briefing.